Well, I mean, I think Jim's exactly right. You haven't actually seen any pressure on the bond market at this point. You know, as we get closer and closer to October 17th, which is the date that I think the media has put as the kind of the debt ceiling deadline, I really think that these talks could even go further than that. I think we could actually, it's not until November 1st that the government will actually run out of cash to fund itself. So as you know, at Eaton Vance, what we're looking to do is, you know, we don't think there's going to be a default in the short term or in the long term, but we do think there's going to be volatility along the way. So you want to, we're trying to maintain the course, and if we do see a pullback in certain markets, we're looking to put money to work, because we think a month, 2 months from now, these markets will actually be higher than they are today, but in the short term you're likely to see a kind of a sell-off, and I think that's what it's going to take. We're going to need to have volatility spike and to kind of ignite a flame under Congress to come to a resolution.
Andrew, just to clarify, where are you putting the money to work? Is that on the shorter end of the curve?
Well, I think, as Jim said, so the short end of the curve is actually, you know, where there's the most you know, stress at this point. So I think you want to actually, if you have money on the short end of the curve, you likely want to move it out a little further onto the curve, and you know, so kind of we're talking 3, 5 year points of the curve. Those actually haven't, on the Treasury curve, haven't actually moved at this point. You've actually seen rates a little lower. It's the short end that you've seen the spike from 1 basis point to 19 basis points on the 1-month T-bills. So I would move away from the short end of the curve and move it out the curve a little bit.